So good morning all. Today's topic is on residential status. Any income earned by a person defined under section 2 as being taxed either based on residence principles and on source principles. Today's topic is on residential status for company and an individual. So section 6 of the Income Tax Act defines the residence principles for individual and for individuals, satisfying which an individual can be classified either as a resident or a non-resident. If resident means he can be classified either as a resident and ordinary resident or a resident and not ordinary resident. These are the conditions that has to be satisfied by that individual. After Finance Act 2020, an explanation has been made to Section 6, stating which is a citizen or person of Indian origin having total income excluding the foreign sources which exceeding 15 lakh rupees instead of 60 days in 120 days has been substituted. Person of Indian origin means nothing but either him or his parents or any of his grandparents has been born in undivided India. So after that, explanation has been added, named Section 6, Explanation 6, Section 6, Explanation 1A, which states that any individual being citizen of India having total income exceeding 15 lakh rupees shall be deemed to be resident.
All intended for export. I suited up to get a look at the production line.
This is definitely one of the cleaner. Fleck, even of dust. So the way
So an explanation has been added to Section 6, which states that a citizen of India having total income excluding the foreign resources which exceeds 15 lakhs is deemed to be a resident of India in that previous year if he is not liable to tax in any other country or territory by reason of his residence. The conditions to be satisfied are: he has to be a citizen of India, his total income excluding foreign resources has to be exceed 15 lakhs, and he is not to be liable to tax in any other country by reason of his residence or any other criteria. So the person falling under this explanation has been defined as resident and not ordinary resident. Apart from it, there are 3 more conditions for a individual to be classified as resident but not ordinary resident. After satisfying the basic resident criteria, individual has to satisfy these 2 conditions. So as per Section 5, which explains about the scope of total income, it explains that any income which accrues or arises to him outside India shall not be included unless it is derived from a business or a profession set up in India. It is a flow chart showing the residential status. So section 6 subsection explanation 1A is applicable to everyone. The issue here is any individual who is falling under section 6 is as a normal resident can also enjoy the status of non-resident but not ordinary resident too. So after 2021 budget, an explanation to this explanation has been added, which states that this condition does not suits for a person who falls under section 6 definition. So any person who has been classified as a resident and ordinary resident cannot be included in this explanation. So for total income, it is just says about total income. It doesn't defines whether it is a gross total income, whether chapter 60 deductions can be set off. Total income should be net taxable income or gross total income. There is not a proper definition for defining the total income given under this explanation. So not liable to tax due to domicile or residence. There is a difference between liable to tax versus subject to tax, which means residents of USA and other countries where there is no income tax liability on individuals would also be covered under this explanation. So a person after being satisfied the definitions given earlier, he has to satisfy the go through the tiebreaker test, satisfying which an individual can be classified either as a resident, not ordinary resident, or a non-resident. So these are the tests that being carried on under tiebreaker test: permanent home, personal and economic interest, habitual abode, nationality, and mutual agreement procedures. These tests we can see in detail in further slides. If under tiebreaker test he becomes a resident of another country, he became non-resident in India, only his Indian income will be taxable and foreign income will not be taxable in India, and in his Indian income will be taxable as per treaty rates or act, whichever is beneficial for the individual, and he need to file his return of income and furnish TRC to get those benefits under treaty rates. If under tiebreaker test he becomes resident of India, which means he is enjoying the status of resident but not ordinary resident, means his Indian income including foreign income from business or profession based in India will be taxable. Foreign income will not be taxable here, and Indian income will be taxable at Indian rates applicable to residents, including surcharge and cess. So these are the implications a person can enjoy after being in the status of resident but not ordinary resident. These are the advantages that a person can face being after being resident but not ordinary resident. So it is a quick summary of the residential status. For financial year 2019-2020, government through a circular relaxation for individuals who has came to India on a visit before 22nd March and has been unable to leave on India on or before 31st March. Such period shall not be taken into account for their residential status calculation. And any individual who has been quarantined in India on account of coronavirus on or after 1st March and departed on evacuation flight on or before 31st March, that period cannot also be taken for the residential status calculation. So a particular source of income not taxable in a state and entity is exempt in state. These are the different scenarios which can be liable to tax and cannot be not liable to tax depending upon the facts and circumstances of the specified cases. So the term liable to tax has been used in section 6 and section 10 and various tax treaties entered by India. It has been defined under section 2 of subsection 29A. It's any if there is a taxability of tax on the person under the domestic law of the country, And it also includes the case where tax liability is getting attracted first and an exception has been provided thereafter. Section 90 explanation 4 has also provides that any term which has not been defined under DTA but is defined in Act, it shall give its reference to the domestic law itself. Article 3 of DTA permits reference to domestic law for undefined terms in treaty, only when context requires. So, Article 4 of UN Model Convention defines the resident of a contracting state. Resident means any person who is liable to tax by reason of his residence or place of incorporation, place of management, or any other criteria. But the term does not include any person who is liable to tax in a state in respect only of this source of income in the state or in that state. So, to claim residence under any treaty, following conditions has to be satisfied. An assessee has to be liable to tax under the domestic laws. He has to be liable to tax by reason of his residence, and such person shall not be taxable in that state because of that source of income in that state. These conditions have to be satisfied on a standalone basis. So, under India UAE DTWA, individuals and companies, an individual who is resident in UAE for a period totaling in the aggregate at least 183 days in the calendar year is deemed to be an resident of that country. And companies which have been incorporated in UAE and which is managed and controlled by wholly in UAE shall be deemed to be considered as resident of that country. So, under India UK is fiscally transparent entity, which is nothing but a pass-through entity has been defined, which states that any income derived or paid by a partnership firm, to the extent that the income derived by the partnership firm is subject to tax in that state, in the hands of its partners or in the hands of the firm itself. Article 1 of OECD Model Convention defines that this applies to any persons who are residents of one or more contracting states. The residence is the primary gateway for an individual to enjoy the benefits of DTWA. It just allocates the taxing rights among the contracting state. It helps the jurisdiction to exercise its primary right and the obligation to grant tax credit. That it has been defined earlier itself. The resident of a contracting state means any person under the states of domestic law is liable to tax by reason of his residence and not only because of its source of income or any income from the capital situated therein. So, entity is a person as defined in Article 3. Person includes individual, a company or any other body of person. Such person is liable to tax in the following factors, either by his residence or domicile or place of management or place of incorporation or any other criteria. Such liability to tax is considered in domestic laws of state, and it shall not be taxed only because of the any source of income arises therein. It is the residency rule as per different countries. Residence rule in residential status in India has been classified based on the number of days in tax year. In USA, the residence status can be classified by green card holding and substantial present test. In UK, the physical presence shall be considered, and in France, residence and the principal place of abode and professional activity or center of economic interest shall be considered. So, an Indian company makes a payment in the nature of fees for technical services to a partnership firm. State or treats partnership firm as a pass-through entity and taxes income in the hands of partners. Whether the partnership firm is entitled to enjoy the benefits of a tax treaty.
State means here the country.
Yeah, country. So it can enjoy the benefit of tax treaty in some cases, and in this case, Schindler-Whitmer, the Supreme Court has held that the company cannot enjoy the benefit of treaty, which means it may depends on the facts and circumstances of the cases. So under Indian UAE DDWA, an individual who is present in the UAE for a period aggregating at least 180 days shall be considered as a resident, and a company which is managed and controlled by UAE can be considered as a resident. So under Indian UK DDWA, it has been defined earlier itself. Any income derived from any partnership firm, up to that extent, it can be taxed in the hands of partners or in the hands of firm. To enjoy the benefit of DTWA, a person shall be entitled to obtain its TRC along with Form 10F. In this CAPS Industries case, TT benefit can be obtained even though it has not declared its TRC. So tiebreaker rule has been defined under Article 4. So individual has to pass through this test to classify himself as either as a non-resident or as a resident but not ordinarily resident. In which state he has the permanent home available. If he has permanent home in both the states, means in which state he has his personal and economic relations closer to him. If he has economic relations same in the both two states, means his center of vital interest cannot be determined, means he has in which state he has habitual abode has to be considered. If habitual abode means the number of days he is being stayed in a country. If habitual mode in both states, it shall be considered as it shall be considered based on the nationality of that individual. If the individual is a national of both states, then the case has to be determined either by the mutual agreement between those two states, those two countries. For permanent home test, the home has to be available for him at any point of time during the year. For center of vital interest rule, his family and social relationship, communication address and spiritual affiliation has to be considered. For economic interest, place of business or profession, occupation and investment has to be considered. So to identify the residential status of a company is said to be resident in India if it is an Indian company. The control and management of its affairs is wholly situated in India. After amending the Income Tax Act, a company is said to be resident in India if it is an Indian company and its place of effective management in that year has to be in India. Place of effective management is nothing but a place where key management and commercial decisions that are necessary for a conduct of business has been made. So the rationale for introducing the concept of poem is many shell companies enjoying the benefit of a company can easily avoid becoming a resident by simply holding a board meeting outside India, enjoying the benefit of DTWA and being a resident of India too. So to avoid shell companies enjoying those benefits, place of effective management concept has been introduced. Many countries prefer the poem test to be appropriate for determination of the residence of a company. It would also be a measure to deal with cases of creation of shell companies outside India but being managed and controlled from India. So after a company has been classified as a resident based on the poem, its worldwide income shall be taxable in India at 40%, including plus surcharge and applicable cess. Applicability of TP provision, including reporting of international transaction, maintenance of TP documentation also be maintained, and it cannot benefit from the treaty between India and US. Applicability of withhold permission also be applicable. It has to comply with the return of filing reporting, TDS return filing and equalization levy, interest and penalty in case that POM is determined in India during tax scrutiny. So key management and commercial decisions means central and importance vital element. Government, it simply means the decisions which are substantive for the conduct of business has to be made there. So determination of poem depends on the facts and circumstances of each case. It's more than substance over form based concept. Entity can have more than one place of management, but it can only have one place of effective management at any point of time. Same as essential status for individual, poem has also be required to be determined on year-to-year basis. So for determining a company to for determining a company has poem in India or not, active business outside India test has to be engaged. If companies are engaged in active business outside India, poem is considered to be outside India if majority board meetings have been held outside India. So companies other than those engaged in active business outside India identify the persons who actually make the key management decisions, determine the place where those decisions are being made, more than where they are being implemented. So until Finance Act 2015, some proposals has been made to determine the determination of poem for the benefit of taxpayers. After during 24th January, a press release has been released for companies determining the place of effective management. The press release has been given a turnover based exemption for companies which have turnover less than 50 crores need not to be classified under the poem characterization. So the circular is binding on the tax authorities and is not binding on the taxpayer, and it cannot expand or shrink the scope of parent legislature. So the poem guidelines have been largely adopted from South Africa Revenue Service. So a company's poem has been to be held outside India if the passive income of such entity is more than 50% of its total income, and the total assets held outside India is more than 50% of the total assets, and the total number of employees employed outside India is more than 50% of the total employees, and the payroll expenditure has been more than or equal to 50% of the total payroll expenditure, and these conditions have to be satisfied cumulatively. And for these conditions to be satisfied, average data of previous 3 years has to be considered. So passive income includes income transactions regarding purchase and sale of goods from or to its, and it also includes income by way of royalty, dividend, capital gains, interest and rental income. So interest income of a company engaged in banking business is not included here in the definition of passive income. Value of asset. Individually depreciable asset has been taken into consideration. Average value as per tax law For pool of assets, average value as per tax law has been considered, and for other asset, book value as per the tax law has been considered. So for considering the value of assets also, average data of last 3 years needs to be considered. Number of employees, average number of employees include those who perform tasks similar to those performed by employees has to be considered. For payroll cost of salaries, wages, bonus and all other employee compensation including social cost borne by the employer needs to be taken into account. So these are the two approaches mentioned in the guidelines for computing the average data computation. So in this case, a company is selling the shares, is selling one of the shares, one of the company to the another company, rendering it a value of 5,000. So it comes to a for 2021, its passive income comes around 98%, averaging the 98% for 3 years comes around 33, which satisfies the active business outside India, which means the company has been classified as having poem outside India. So it is the meaning of income and the income which can be taken for the computation of passive income calculation. To determine poem, the persons who can actually make the key management and commercial decision for the conduct of business as a whole has to be considered. So a holding company can intervene in the activities of subsidiary company. That simply doesn't means the subsidiary company's poem is held outside India. After classifying as a company resident in India, during the first year, the computation income has been computed under Section 115JH of the Income Tax Act. For depreciation calculation, opening tax if foreign companies assessed to tax in that foreign country should be considered. In any other case, opening book value in any other cases shall be considered. So for unabsorbed depreciation, brought forward loss on the first day of previous year as computed under tax law shall be considered. In any other cases, on the first day of brought forward loss or unabsorbed depreciation on the first day of previous year, other cases shall also be considered. So before introducing BEPS, a company in which have its place of effective management in India or outside India shall be taken as the criteria for determining the restricted status of the company. After introducing BEPS, the place of effective management, the place where it is incorporated, and other relevant factors has also been considered to determine the restricted status for the company. So OECD has also given some factors to be considered to determine place of effective management, where board meetings has been usually held, where chief executive officer and other executives usually carry on their activities, where the senior day-to-day management of the person is carried on, where the person's headquarters are located, and which country law governs the legal status of the person, and where the accounting records are being kept. So, there is a company has been incorporated in Luxembourg, having its shareholders in Australia and Bermuda. The Luxembourg company has been transacting one with an Italian company to enjoy its DTAA benefits. So it can enjoy the benefits of DTAA as of Italy only if the parent company has demonstrated that the principal purpose is not only to enjoy the benefit of the DTAA, and Luxembourg tax authorities has also give certificates to prove that the holding company's poem was located therein. So apart from that, to enjoy the benefit of special purpose vehicle, the company has incorporated in Luxembourg and being transacted the transaction with the Italy only. The basic principle is the holding company has to justify itself that it is not only the sole purpose to enjoy the benefit of DTAA, it is the for other reasons also the company is being transacted with the other entity in another country.
Thank you.
Thank you.
Any questions?